Real life doesn't work that way. Markets go up and down, spending changes, and sometimes we need flexibility. Our Guardrails approach is built on that concept. It says that your retirement withdrawals shouldn't follow essentially a straight line. They should adapt and be dynamic. I'm about to tell you the story about two clients who just retired. Life is good, they're traveling the world, they're having fun, they're living it up, all because they did a retirement plan. And when they did that retirement plan, the results looked like this: a high retirement success rate that left them over $1.3 million at the end of that plan. That sounds pretty solid, right? And yet, 10 months later, when they go check in with their financial planner or with one of those free retirement planning tools out there, their financial plan looked like this. Could you imagine using a retirement planning tool and putting your faith into it, calling your boss, letting them know that you're officially retiring, having that retirement party with your friends and family, and then 10 months later, seeing this? Now, I know a lot of people watching this would be downloading the DoorDash app, not to order a meal, but to apply for a delivery job. I know a lot of people watching this would be pulling up their boss's contact in their phone, not to delete it, but to shoot them a call and ask for their job back. And yet, at the same time, with all this going on, the retirement success rate using a different methodology has a 99% success rate. So how does this happen? How do we get a retirement plan using above and beyond the most popular method to determine if you're on track to retire, that showing an abysmal success rate of 37%, and yet have another plan show a 99% success rate? Well, that's exactly what we're going to break down today. If it's your first time here, my name is John Boyd. I'm a certified financial planner and I'm the founder of MDRN Wealth. If after watching today's video, you feel like you would benefit from one-on-one early retirement help, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. So let me tell you about our clients in our case study today. So we have Joe and Jill. They are married, newly retired. Both of them are 60. And they have $1.5 million in a pre-tax retirement account. We're also going to assume that they get $3,200 a month in Social Security benefits at full retirement age. We are also going to assume they have a balanced 60-40 portfolio, which is 60% stocks and 40% bonds. Their goal is to spend $8,500 a month in retirement. Now, when we run their retirement plan using the popular method, we get a 74% success rate. So what exactly does this mean when I say popular method? Well, for starters, what you're looking at is called a Monte Carlo simulation. And this is the backbone for the vast majority of retirement planning tools out there. From expensive tools that professionals use to even free ones online, these simulations are the star of the show. And what they do is they take your retirement plan and all the variables that you plugged into it, and they simulate it against 100 different market scenarios and determine a success rate. And in our case, success is dictated based on our ability to spend $8,500 a month in retirement. But here's where things get a little nasty. Let's say a simulation couldn't support $8,500 a month in retirement, but could support $8,499 a month in retirement. So just $1 less a month. That would be considered a failure. So what exactly happens 10 months later and causes this plan to fall apart? We'll take a look here. We are looking at 2022. And if you guys don't remember 2022, this was a period where the market entered a bear market, which is categorized as a sell-off of 20% or more. What's unique about this period is that 40% of bonds that we have allocated in this portfolio would have also collapsed in value. So 10 months into 2022, their balanced portfolio has fallen 20%. it goes from 1.5 million down to 1.2 million. And so at this point, Joe and Jill logically are feeling a little nervous since they just retired. And so they rerun their retirement plan, and that's when they see this, a 37% success rate. Now, as I mentioned earlier, we ran this exact same plan using a different methodology and had a 99% success rate. So what you're looking at here is called a guardrails approach to retirement income planning. Most people think a retirement plan is something you set once and forget. Like in this example, we spend $8,500 a month adjusted for inflation annually, and that's it. But real life doesn't work that way. Markets go up and down, spending changes, and sometimes we need flexibility. Our guardrails approach is built on that concept. It says that your retirement withdrawals shouldn't follow essentially a straight line. They should adapt and be dynamic. So let's see how it works. We determine how much we can spend based on your portfolio, goals, income sources like Social Security, etc. Then, periodically, you check if your portfolio has grown or shrunk enough to hit a guardrail. If you've hit the top guardrail and there's sufficient growth, you would increase your withdrawals. So in this case here, we take their $1.5 million portfolio and determine they can spend $9,035 a month comfortably. This is really good news because remember, they're spending $8,500 a month. So seeing this $9,035 figure actually shows they could spend a little bit more. Now let's say that their portfolio grows 7%. At that point, they can give themselves a pay raise and bump their monthly withdrawals up to $9,650 a month. Now this is where a guardrails approach is very different than a Monte Carlo analysis. With a Monte Carlo analysis, the thinking behind it is very rigid. And as a result, as markets fall, so does your retirement success rate. But with a guardrails approach, we understand that markets are going to pull back. We understand markets will have down years, but eventually they'll come back. So we have a buffer against that. So what you can see here is between 1.5 and the bottom guardrail of $1,171,000. If our portfolio falls, let's say 20%, which happened here in our story today, to 1.2 million, based off this data, do we need to adjust our spending based on our guardrails approach? The answer to that is no. We can maintain our $9,035 a month in spending and be just fine because we fell between that guardrail. However, if the portfolio did fall below the lower guardrail, this is where we would need to cut spending by about 5% to $8,583 a month in order to sustain a successful retirement. And that's how this plan had a 99% success rate, because it assumes our retirees are being disciplined and following these guardrails. That, ladies and gentlemen, is why a guardrails approach, in my opinion, is much more effective than a Monte Carlo analysis, because that's what happens in real life. In the event we face an unprecedented market sell-off like 2008 financial crisis or 2020 COVID era type of sell-off, you might have to dial back spending a little bit once your portfolio recovers enough to go back to your normal spend rate. A Monte Carlo analysis doesn't think like this. It's rigid, it's very black and white, and doesn't count for the fact that you might temporarily dial down your spending even a little during a period of significant market distress. And that can greatly change the outcome of the plan. So there you have it, guys. If you feel like you would benefit from a guardrails-based approach to retirement planning, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. I will see you next time.